This is Chip Maxwell, and you're listening to the Retire Smart podcast with David Brooks. Today, David breaks down the growing disconnect between Jerome Powell's optimistic economic outlook and the mounting signs of a slowdown, including a surge in announced job cuts and softening real estate prices. He discusses the ripple effects of declining cash buyers, rising housing vacancies, and what it all could mean for interest rates, inflation, and the housing market in the months ahead. David, I do want to ask you about the housing market, but first, it's Jerome Powell this week on the show. You sent the team something. Well, Jerome Powell says the economy's strong. No rate cuts right now. Job market strong. No rate cuts. Meanwhile, and you sent us a chart called United States Challenger Job Cuts. What is this telling us?
The Challenger Jobs Report, this is companies letting you know of job cuts they're about to do, or they're announcing job cuts. They haven't fired the people yet. So this is a leading indicator of where job cuts will come, typically a month or 2 months later, depending on severance packages, et cetera. So you can see on this chart, if you're watching online, there's quite a bit of a spike there, right? So now you're well over 250,000 job cuts announced in a month, precluding going. And just as of this morning, Intel just announced 20,000 job cuts, right? So companies are starting to fire people. This has nothing to do with the tariffs. This is the economy was slowing down. We've been talking about it for 2 years. The sell-off in the markets is an excuse base, right? They always look for the excuse to revalue the portfolios to get things into normal market conditions. And again, when the stock market went all the way down to about 5,200 on the S&P 500, that was a pretty big drop. We went below that, but that got it to where it was almost fair value, at least by some metrics, right? And if interest rates continue to drop, then the market's probably getting back to being fairly valued. If interest rates do not drop, then the market will most likely have another leg lower, 10, 12% or so. But job losses are going to mount, and they're going to continue in the near future.
I think you said earlier in the show, you think in May, Powell and the Fed will make another rate cut.
Yeah, I think they're going to have to, simply because the job numbers that will come out between now and then are going to be sufficient data for them to say, okay, we need to get this going. But the problem is, now, again, the faster that Trump and them announce deals on tariffs, the faster he'll get the rate cuts. And I think that's also what Scott Besson, who we've talked a lot about this week, has in his ear saying, listen, if you get the trade deals done, then the inflationary pressure that is being talked about from these tariffs would go away, and you would then have deflation, which we are seeing across the board, right? We've talked about inflation's come down, and Trueflation this past month was at 1.22%. It's a great website, trueflation.com, just no E on true, so TRUinflation.com, and you can look for yourself, and it just prices the goods and services we buy most every day, and it was at 1.22%. So that gives the Fed room to cut rates on the inflation side. So they have two mandates, inflation, right? And then they also have full employment. Well, if job losses mount, as we're talking about, then they're going to want to cut rates to encourage people to hire people. But the other telltale sign, Chip, is the real estate market, which got a little lofty due to all the stimulus checks that people got, and people were working from home. So I don't have to live in San Francisco, so I'm going to move to Austin or whatever, and I'm just getting paid the same amount of money, and I got stimulus checks, I'm flush with cash. Well, I'll buy this house that's overpriced. It doesn't matter. Interest rates were at basically zero back then, and they got these mortgages, and now they're finding out, well, wait a minute, taxes and insurance alone, I can't afford this house, let alone the low mortgage. And so houses are starting to come to the market at an incredibly fast rate. So we're seeing inventory launch not only on the single-family market, but on multifamily as well. Vacancies, and I sent you a chart on this, vacancies on apartments, multifamily, are basically at all-time highs now. Normally apartment complexes run with very little vacancy, just 3 or 4%.
Well, let's go ahead. Thank you, Producer Shannon. There's the chart right there that you sent us from Arbor Research and Trading about apartments and rental vacancy approaching new highs.
Yeah, so just before the COVID slowdown, vacancies peaked up around 6.5%. Now we're approaching 7%, but we went all the way down to zero because people were renting a second apartment. They were flush with, again, stimulus cash they didn't really deserve to have in their pocket, and so it was sent to them. So while they sold their home, they might have rented another apartment, and then you had a mass influx of people investing in multifamily. It became all the rage on social media, and so now we have apartment. I mean, just look here in Omaha. Omaha. I live out near Gretna, and there are things being built everywhere, and there are for lease signs at all of them, gigantic. So they're struggling to fill the units as they build them. And so that typically means, on the good news for folks, lower rents. And so we have a couple of our young employees that, that live in apartments and what have you. And one of them was shopping. He's like, yeah, the rates actually came down $150 for the apartment I was looking at just 3 months ago. So I'm like, yeah, you're going to see rates soften if vacancies continue to increase, because if you're the business owner, and I've owned multifamily personally, so what do you want? You want cash flow. You want somebody in the unit. Certainly you want the max rent you could charge from a return standpoint, but you'd rather have somebody paying $800 than nobody paying $1,000 that you advertise it, right? So yeah. I think you're going to see deflation in real estate pricing, both on the asset side, the price of houses, and on rents that people are paying. And that will be deflationary, which will give the Fed more cover to, again, cut rates. Why I think you're going to hear a rate cut coming here in May.
Okay, now the chart you sent on home purchase from U.S. Department of Housing and Urban Development. By the way, that's time-stamped 6 a.m. You must have slept in that morning. But you said housing market about to get ugly.
Yeah, again,
Why?
Same thing, because cash buyers have disappeared. So, and I'm an investor, right? And that's typically when I purchase rental homes, almost always I pay cash for them. Even if I want to put a mortgage on it later, I have the ability to pay cash, or I have a line of credit available, so I could just pull a line of credit. I'm a cash close, which means I go to the front of the line with my offer if I want to make an offer, and I get to do it done. And then if I want to put a mortgage on it after I put a tenant, I could do so. But cash buyers are the investors, right? Well, they're pulling out of the market. And if you look on this chart, I showed you what happened during the Great Financial Recession, right? Cash buyers just vanished for a while, right? Because investors had margin calls on the stock market, the volatility like we're seeing now. They had to put their cash to work for other things, and the prices of their assets were dropping aggressively. So they stopped being buyers of those assets. So they pulled away from the market, and that's why the prices dropped. Now, across the country, we saw housing prices drop 7 to 12%, but in certain markets that it was really high, like Phoenix and California, you saw a crazy drop. Where I lived in Brevard County, Florida, at the time of the Great Recession, that's the Space Coast, Chip. We had Obama promise to keep the space program running at full steam when he got elected his first term, and that promise was not kept. And of course, I'm not saying it was 100% based on that, but we went through the Great Recession, and so they had no budget. So we had over 80,000 people in Brevard County, Florida, which is a county very similar in size to Omaha proper, about 500,000 people at the time. 80,000 jobs that paid over $100,000 a year were vanished, right? So it wasn't all directly in the space program, but it was engineers, Lockheed Martin, Northrop Grumman, all the companies, Boeing, Space Alliance, et cetera, that work with that program. And with that kind of drop, we had some neighborhoods drop 50 to 70% in value of their housing prices.
What a shockwave.
Yeah,
Ooh.
and so you had foreclosures everywhere, strategic defaults, et cetera. So again, I'm not saying that's necessarily what's coming, but it's going to get ugly for the housing market because we have ghost neighborhoods. We talked about that a few months ago, and we'll report more on that coming up. And if you want to follow stuff, somebody to follow in this who reports a lot on the housing market, a lady named Melanie Wright, who sells research on stuff. I do follow some of her research. But anyway, it's just interesting. But if you're a home buyer, hang tight. You might get a better offer here soon. I have a neighbor who moved into my neighborhood, paid, I think, around, a decent home, right? I don't know, but he decided to move back to Minneapolis, where he moved from just a year ago, a better job offer, and he listed his house for almost $100,000 more than he paid for it, and no bites. And now he's already had to drop the price by $40,000. I'm like, and I saw him walking my dog. I'm like, why don't you just sell it for what you paid for it and get out of here? You know, people sometimes, it's worth this. And the longer that sticks on the market, the harder it's going to be to sell and the bigger the discount you take. So take heed if you're trying to sell a property right now.
David, you flagged a statement, and some other people in the financial industry have as well, made by a gentleman named Neil Kashkari. A statement made in 2020 and then a statement made more recently in 2025. Who is Neil Kashkari, and why did you flag this statement?
Okay, have you ever seen the movie The Mummy with Brendan Fraser?
I have not.
Okay, so
sorry, I can't help you out there.
So the villain in that movie, that's Neil Kashkari. No, if you go look up a picture of him, in fact,
is that right?
Maybe Shannon can edit it and put it right in here. So Billy Zane plays the character in the movie Bald, but that's what Neil Kashkari looks like. It reminds me. So I'll see if Shannon can actually get that image edited into the show here. Neil Kashkari, he used to work for Allianz, but he is a Federal Reserve, works for the Federal Reserve, right? Okay. So he's one of the voting members of the Federal Reserve out of Minneapolis. And he's very very left-wing in his approach to economics, if you will. And so during 2020, basically after Biden was put into office, don't worry about anything. We have an infinite amount of cash at the Federal Reserve. Now, flash forward 5 years later, Trump's in office.
Ooh.
Well, you see, the thing is, you can't just spend this money. You need to be responsible with your spending, right?
Okay.
So very different. But the reality is the Federal Reserve, and boy, we could get a whole show on this, has lost $192 billion in the last 24 months. It used to make money because banks would deposit money, they'd make interest on it. They've completely flipped, and we won't have time today, but we're gonna talk about an abundant reserve versus a scarcity reserve system at the Federal Reserve, and we have tons of research on that. But again, take heed out there. It's not all clear. Be careful what you wish for.
Thank you for listening to the Retire Smart podcast with David Brooks. If you want to learn how to generate lifetime income, reduce your tax bill, and maintain your lifestyle in retirement, visit retiresmartpodcast.com. And make sure to subscribe to keep up with new episodes every week.